It's how you think about it. It's how you frame it in your own brain. But here's where my brain, I trained my brain, I guess, to have rebuttals to both of those. If it's a cash cured put and it blows south through my strike price, and I'm going to get assigned at a much higher price than where the stock's trading, well, it's just no different than if I put in a limit order to buy the stock anyway. I mean, if I just waited for the stock to get down to the level where my strike was and I bought it and then the stock tanked after that, would I be beating myself up for a stock that I own in my IRA that I'm going to hold for 5 to 20 years or something? No, like you'd drive yourself crazy if you beat yourself up every time one of your investment stocks was lower than it was where you bought it. I mean, that's the difference between trading and investing. I think you're in it for the long haul. So I don't know. I just have a hard time even really being that upset about that occurrence.
Hello, Wealth Builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hey, Wealth Building family. Welcome to episode 80. Two guys talking about the wheel. Humans learn by storytelling. That's been the same since the caveman days. They sit around the fire and they tell stories while drinking beer. I don't think they had beer back in the caveman days, but that's how it typically goes these days around the fire. And that's kind of why I have this podcast, because I know that that's how it goes. You learn through storytelling, and that's basically what a podcast is, isn't it? Every year I set a goal for myself to read a certain number of books, and this year I'm really, really behind, but that's mostly because in my free time, I listen to podcasts instead. It's basically just like, hey, tell me a story instead of me reading a story. Whatever the story is, fiction, nonfiction. I tend to do a lot of nonfiction, but And so I thought, what would be fun today? What could be possibly more fun today than two guys just talking about the wheel? And so that's what we're going to do today, because we have a very special guest. To help us talk about this, I want to bring on someone who's helped thousands of traders to use the wheel strategy. He's a frequent guest and a good friend to the show. Please welcome John Kmiecik. Hi, John. Welcome back to Wealth Building with Options.
As always, great to be here. Great to be with all of you.
So, John, you are on the front lines and you're doing a lot of one-on-one coaching with our student traders. You're doing the group coaching every day. You're talking a lot about the wheel. And more importantly, you're hearing people talk a lot about the wheel. What are people saying about it? And tell me about some students maybe who weren't doing the wheel before, and did anything change for them, and how's all that going? Let's talk about your experience talking with our student traders.
Yeah, it's been interesting. It's been kind of a collage of people that are doing the wheel and they didn't know it was actually called something. Like, yeah, I've kind of been doing that for a long time, and I actually didn't really know it had a name to it. And then people that I've introduced to it, thanks to you, that really had no idea that something like this can exist. I mean, I was just working with someone today, and in fact, he's like, this is tremendous. He's like, this is honestly not like being a selling point, but this is paid for my one-on-one coaching. Just you showing me how to do this. And it's been really, really interesting. It's really been eye-opening for myself, because up until like 6 months ago, I really never talked too much about this. And now I'm getting requests for it. I'm introducing to people. And, the stigma that you got to have a lot of money in your account or be some big investor with, multiple millions of dollars to do this. is where I really get excited when I show people, especially when you showed me how to calculate the annual percentage. And I kind of show them, they're like, wow, I never really I just didn't think this would be a 38% return. It feels like I'm just bringing in 25 cents and it's really nothing there. But when you actually annualize it out, that's actually a pretty good return. I actually had this guy tell me that today and stuff. So I say, obviously you've always done your little stock there. What is it? TMC. And I show a lot of people on that stock, and it really kind of introduces them, if they're a little bit nervous or have smaller accounts, to the wheel strategy. And from there, I think it's developed. I mean, it was a student last week, and he was showing me, he started out with TMC. I kind of recommended that, that one's worked out pretty well. We've been playing with it. Now he showed me a whole Excel spreadsheet of the ones he's been doing. He's been looking from different sources like Investors Business and all these websites he's been looking at and so on and so forth. He's built up like 7 of them that he's doing on a regular basis. And he's like, you know what? It's almost kind of, I don't know, like soothing to him to like move away sometimes from option swing trading, as we know could be a lot of stress, and do something where he's not nervous all the time or rushing to the computer to look at, oh, what's the market doing today? Oh my God, those bull put spreads are getting crushed today. And it's kind of, like I said, kind of almost like hate to say it, but like, what's the word I'm looking for? Kind of not soothing, but when you meditate, it's kind of like a meditation that it's not as worked up as they are with swing trades. And then, like I said, they look at their account growing over a period of time, and it's really been incredible. So to me, it's really not being funny, though. It's really been eye-opening to me that I never thought I would be teaching so much and doing it myself so much, but it's been all over the place with people that know it, didn't know they're doing it, people that are requesting it, and people thinking that they can't do this with a smaller account, but they really can. So it's been really great. It's, like I said, it's really turned me on my head as a teacher and teaching options,
Yeah, it's funny about the wheel where it is kind of a little bit, I mean, for me, yeah, meditative. I never really thought of it that way, but that's a pretty good description. And you don't get all the excitement, like you don't get all that immediate gratification excitement as you do with swing trading, but you nailed it on the head. Like when you look long-term what it's doing, it's like, holy crap, why is my account growing so fast? And funny story, just today, I got asked a couple of days ago by a host of a podcast on options. And he said, okay, so what do you want to talk about? And I said, well, my new book, Build Consistent Wealth with Options, is all on the wheel strategy.
You wrote that book? Wow, I didn't know I was sitting here with the author.
Well, you proofread it, so.
Yes, I did. Yeah.
And so I said, yeah, it's all on the wheel. So how about that? And he came back and he said, well, I don't think my audience would really be interested in that. In fact, I steer them away from that. And I don't really know the guy or anything like that, but it was interesting to hear him say that. And I wondered why. Like there's all these studies that show that it does outperform in the long run. And I mean, gosh, I lay out some great cases for that in the book, but it's stylistic. Some people just need that morphine blast to the veins and, whatever. They just like that excitement, or maybe he thinks that's not exciting to talk about on the show, but I don't know. I mean, it is the difference between investing and trading, I would say. So maybe that was the guy's logic, but as an investor, I mean, I don't know what's more exciting than growing your money faster than you otherwise would.
Yeah, no, I mean, again, we don't know either, but I would guess, like you said, it's not as crazy. Like, oh my God, I put on this bull call spread. My stock is $7 higher today. I'm up, 35% already. And yeah, it's not as crazy as that, as exciting as that, but trading should be boring. Investing should be boring. I had a student last week just tell me that. It's like, I know I'm doing well. I'm not getting excited. And it's actually kind of boring. I'm following my trading plan. I'm doing this and that. I'm doing the wheel, and it's nothing exciting, but I'm just watching my account grow. Is that what trading investing is supposed to be, John? And I'm like, we just start laughing together, but that's exactly it, though. So, yeah, so it might not be the most glamorous topic, again, who knows what his reason? Like you said, it could be the investment aspect versus, more trading, but people need to lose that illusion of that it's not exciting, because it is exciting. I'm excited to watch my account grow.
And honestly, I think there's a lot of interesting stuff regarding the wheel. You can get really deep and cerebral with what exactly makes it tick and why it's better and how to optimize it. And the main thing is just this idea of the risk premium, what a lot of people call the risk premium, which is just that observation that implied volatility is overstated in the long run in general, on an average. Definitely not always on all options every single time. But, you look back over a year of SPX trades or SPY trades or even the market in general, and implied volatility will have been too high. I don't know if there's even been a year since 1987 where it wasn't. And so that's one of the things that makes the wheel tick and is really, I don't know, I'm kind of a nerd, kind of interesting to think about. So that kind of begets a question. Right now, as we're recording this, VIX is sitting below 15. Now, I don't know when this comes out, which is going to be about a week from now. The VIX might be a lot higher, might be lower, might be right here too. But a VIX of 1455 here after market, I mean, does it make sense for people to actually be doing the wheel right now with vols this low?
Yeah, I mean, even before I get to that, but you're right. Being a geek, though, you can make the wheel as exciting as you want. Calculate the annual return, calculate what we're talking about right now, IV levels, right? All right, when they're high or low, what's the percentage difference I'm bringing in at certain times? I mean, so to me, you can still make it exciting. And if you're a math geek and a spreadsheet geek, it can be really, really exciting. Now, getting back to these low IV levels, and I've definitely noticed it. I always say when I'm teaching options, investing and trading wise, I'm like, the one thing I can't teach you is the experience behind it, right? That you have to learn yourself. So a lot of times, without even looking at IV levels, you'll know when IV levels are higher or lower. Not every situation or no situation is ever going to be the same. But without a doubt, you can notice that. But clearly, if you look at the VIX, as you mentioned, being pretty much hanging at the lowest level in a long time, yeah, I mean, again, you have a calculator, unless you're that smart to calculate in your hands and your toes and your fingers and your toes. But to calculate, is it worth it, right? And everyone has a different answer for that. Is it worth it for you? I mean, for me, for the most part, you're selling premium. You're still doing better than anyone that's sitting there, on their hands and not doing anything. Oh, there's just not enough premium there. Why am I going to waste my time with that? Well, again, there are some trade-offs, and I think we'll mention a little bit later here, a little bit, and so on and so forth. But I still think it's worth it to do it no matter what IV levels, no matter what option premiums are telling you right now. So certainly there's a time to maybe scale it back, just like you want to be selling covered calls when your stock is moving vigorously higher and you're limiting your gains and so on and so forth. Yeah, but at the bottom line is, though, the opportunity is there. You have a calculator, you can calculate it, see if it's worth it at this point, right? You have technical analysis you could base it on, so on and so forth. So to me, I think there's times that are better to do it than not, but I don't think there's many times that you don't want to consider doing the wheel strategy, no matter what IV level they're saying. What's your thoughts on that?
Yeah, I mean, consider it absolutely always. I mean, I don't believe that the wheel is perfect for every stock under every situation. But yeah, no matter what the volatility regime is, I consider doing it on all my stocks. And a lot of them, some of them I take a very active approach where if the implied volatility is not high enough, I'm just not going to do it. But a lot of them I take more of a passive approach where I just want the covered calls on or the cash secured puts on at all times. And I just keep it going and take advantage of the fact that the risk premium should be there on average by year's end. And so even if this part of the cycle I'm selling an implied volatility that's arguably a little bit low, well, next time I'll be selling one that it's a little bit high. So it kind of can all work out in the wash. Yeah. Okay, so let me throw it back to you. Here's an interesting one. What do you think about NVIDIA and the wheel right now?
Well, as we're talking, NVIDIA's got earnings in about a couple weeks coming up. So implied volatility levels that we've been talking so low, well, they're pretty high for NVIDIA as we get closer and closer to earnings here, so on and so forth. But to me, that's a great point. Always consider it. I always say it's kind of like a picky eater. Do I like everything I eat? No, but I try everything, right? And that's the same thing with a wheel. You may not like what you're getting out of that low premium, but at least try it, right? And so now getting back to NVIDIA here for sure. I mean, again, you have to go in with the mind frame that you don't mind owning the shares, right? Let's say you're starting out with a flat position, you don't own shares of NVIDIA and you're looking for it. So why not take advantage of a situation where option prices are going to be a little bit more expensive, right? And again, it's a trade-off. How close you want to sell your put to where the underlying is trading, right? So on and so forth. But the bottom line is you have to go in either case, whether you want to be so-called more aggressive and sell closer to the underlying trading or further away. But I think the mind frame still has to be that you don't mind owning the shares no matter what happens here. So to me, when I look at these opportunities over earnings announcement, I just think they're great opportunities, especially on a stock that's, if I have a student that's an investor, I can't even think of one student that doesn't own shares of NVIDIA. So at least 100 shares. So it's pretty funny though, because that's the first thing I kind of ask them. It's almost like a running joke for myself. Do you own shares of NVIDIA? Or, well, I don't, but I've been doing cash secured puts on them and I hope to get them back as part of the wheel strategy. But if they are doing any type of that, I swear almost every person, and even my friends that still will, refuse to, what, that still seems too complicated to me. I'm like, all right, I'm not going to ask them again. I'm not begging for me to teach them. So, but even they have shares of NVIDIA, but I just think it's a golden opportunity that comes along 4 times a year. So why not take advantage of it? That reminds me, as we were talking about NVIDIA, what we were talking about earlier with the wheel, especially being new to a lot of the students and so on and so forth, or students that have been trading it, didn't even know they were trading the wheel. When did you first come across the wheel? By name or even not knowing that you were doing the wheel? I mean, was it something you did yourself? Someone introduced you to it? Did you read it somewhere and stuff? I know you only read your books, but did you read it somewhere else or someone told you about it?
Well, I had sort of a weird path in my trading. A lot of people with anything that, they learn to crawl and then they learn to walk, then they learn to run. Whereas my first trade was in the SPX pit on the floor of the CBOE. So I was a professional trader first, and a specific type of professional trader, a market maker, where I wasn't going out and trying to find trades. I was taking the other side of other people's trades, and that was that. So I never really seeked out covered call trades or cash secured put trades or anything. I just stood in the pit and somebody said, "Hey, what's the market in these puts?" And okay, well, somebody ended up selling them to me and it was probably a cash secured put and I didn't know. I just delta hedged them. So my first real job, because I don't know, it's hard to count being a market maker as a real job for a lot of reasons. But my first real job after being a market maker was working for the exchange teaching options. And that might be hard to count as a real job too. It was sort of like a halfway house between, this crazy thing of being a floor trader to working with a bunch of people in an office who a lot of them were floor traders and get it. But
your last real job might have been when you were 16, huh?
Yeah, exactly.
I don't consider this a real job either. So yeah, it's more of a passion for both of us, right?
I know.
Yeah.
So I remember getting a PowerPoint from Jim Bittman, who taught me how to teach options, a legend in options education. And he was like, okay, you're going to teach covered calls. And I'm like, covered calls? What is a covered call? And I was like, oh, you mean a buy rights? He's like, well, yeah, but, and then cash secured put. I'm like, what's a cash secured put? And so I learned there that, oh, this is what retail traders are doing. This is what the people on the other side of my trades who did all the planning and did all the thinking and sent the trade to the exchange. And I took the other side of it, unknowing, what it was. And it was pretty eye-opening. And honestly, it took me a while. It took me a while to really sort of get it. And it took me especially a while to really get cash secured puts. I was averse to those in the beginning, and now I've come to realize they're less risky than covered calls because you typically have a lower strike, so you have lower absolute risk, and the implied volatility is higher, so you get a greater edge on them. And you've just got a lot of wiggle room before you really start participating in the downside. Whereas covered calls, it's worse in all three of those for covered calls. But I didn't really get it at first, but now I do. And now that's like my favorite thing to trade is cash secured puts.
That's understandable, right? It was a different mind frame for yourself and so on and so forth. So, and there's, of course, as I always say, there's lots of moving parts with options, trading and investing. And speaking of that, lots of moving parts. Have you ever been bitten by the wheel? I mean, there's no perfect option strategy, investment, swing, day trading, so on and so forth. But have you ever been bitten by the wheel and it just ended up being a bad trade, which I could probably guess what this answer is going to be to some degree, huh?
I think it's a hard question to answer, really, because I could recall years ago, before I had the wheel really dialed in, selling a covered call, trying to give it $3 or give the stock $3 of room to appreciate and taking in 95 cents in option premium and watch the stock go up $40 and be like, oh crap, or the opposite, sell a cash secured put and it just blasts through your strike price. And it's like, oh, well, I'm getting assigned at 120 and the stock's at 93. Oh, geez.
Yeah. It's funny you mentioned that real quick, because I honestly think it's about 50-50 reaction with my students, whether it's blasted by their short call or blasted by their put. I honestly think they get more upset blasting by their call than their put.
Yeah.
Because they have that mentality, it's going to come back anyway. And a lot of times it does and stuff. But it's funny you mentioned that. But I think there's more anguish, like, oh, man, I could have made more money if I would have sold that call strike higher. Sorry, I didn't mean to cut you off there, but I just made that point, though. Yeah.
Mm-hmm. No, man, it's totally true. Mm-hmm. But, I feel like now I just don't look at those things as being bitten anymore. And are they? I don't know. I mean, it's how you think about it. It's how you frame it in your own brain. But here's where I trained my brain, I guess, to have rebuttals to both of those. If it's a cash secured put and it blows south through my strike price and I'm going to get assigned at a much higher price than where the stock's trading, well, it's just no different than if I put in a limit order to buy the stock anyway. I mean, if I just waited for the stock to get down to the level where my strike was and I bought it and then the stock tanked after that, would I be beating myself up for a stock that I own in my IRA that I'm going to hold for 5 to 20 years or something? No, like you'd drive yourself crazy if you beat yourself up every time one of your investment stocks was lower than it was where you bought it. I mean, that's the difference between trading and investing. I think you're in it for the long haul. So I don't know. I just have a hard time even really being that upset about that occurrence, the stock going far south through your put strike.
You are right. That is a correct approach, but you'd be surprised, or maybe you wouldn't be surprised, how many people I do have to, again, I call myself the Dr. Phil of options trading, but how many people I have to look at them in a different perspective, right? And honestly, I had the one guy just say, he's like, when you really framed it the way you did when you told me about this, it took me some while to sink in, don't get me wrong, but I just have a different perspective of what I'm looking at now. Before I would just get, just mad about the whole circumstance. But yeah, if you bought it here, it'd be the same principle as you buying those shares at $100 and they're trading at $75. If you got, a stock to go well below your short put strike and so on and so forth. So it's just turning it on your head and saying, this is how you need to view it. And I'm not painting it through rose colored glasses here. but it is the truth. But it's so many people, it's just the human instinct not to be wrong. Like, oh my God, I picked the wrong put strike. Look how far it went against me. Woe's me, bad luck. Why that geopolitical event happened, so on and so forth. But that could have happened if you just bought the shares. It's just how you have to frame it in your mind and be realistic about this stuff, though. Like I said, I just get so fascinated. I know you get fascinated with the numbers. I get fascinated with the psychology of trading and investing. It's really crazy.
And don't get me wrong, like years ago, I mean, I was definitely in that boat. I was definitely like, oh, get emotional about it, but I don't know. I just don't anymore. And oh, I do want to talk about the upside too, blasting through your call strike, because I have a built-in brain rebuttal for that one too. You know, you're just playing a different game. And once you realize that, I don't know, I think you really stop caring about the stock blast through your call strike, because you know that when the stock doesn't go up or down too much, you're going to outperform. You're going to bring in this premium. And if you're doing the math right that we talk about on the show, looking at the annualized return, whether it's the skate yield or doing it for the covered calls, you know you're outperforming, and you know you're taking in meaty premiums. And also know that sometimes the stock's going to go up too much and you're going to have to buy those calls back at a higher price, and you're going to have to give back some of the meaty premiums. And so when you just think about it that way, that, okay, sure, I'm making 25% annualized return on this one, 18% annualized return on this one, 30% annualized return on this one. Well, a couple of those aren't going to work out. And so what you actually get is maybe it's closer to 15% annualized return and 18%, but still it's really, really good. So yeah, you're just playing a little bit of a different game, I think. You will always miss out on those ones that just take off to the moon. And there are some of those. That's why the log normal distribution has that long, long, long tail to the right side, because there's always going to be a stock every now and then that just blasts from $20 to $400.
Yeah, who doesn't want their stock to stop a penny above their put strike and a penny below their call strike? But it's just not going to happen. And if it does, that's the day you say, you know what? I'm treating for dinner today. So it's just not going to happen on a consistent basis. But you feel like as a human being, you got to be perfect, but you don't, because life and investing and trading with options is never perfect. That's for sure.
Yeah, yeah. I mean, being good at anything is, you're never perfect at everything. If I could always buy the low of the day and sell the high of the day, that'd be great.
We wouldn't be having this conversation.
Yeah, exactly.
Mhm.
Well, John, thanks a lot for joining us and sharing your thoughts. Do you have any parting words for our guests before we wrap it up?
No, I'm just always fun to be here. Like I said, it honestly, this stirs me up as much as hopefully it stirs you guys up too. It just gets me thinking and makes me a better, trader and investor and teacher as well then too. So I love doing these podcasts.
And that about wraps it up for this show. But before you go, let's talk about how you can get the most out of the Wealth Building with Options community. First, make sure you're subscribed to the show in your favorite podcast app. And if you're already subscribed to the show, you can go even deeper and get more with a paid subscription. With a paid subscription, you'll get video extra podcast episodes, so you can get hands-on video training on things we talk about, subscriber-only posts where I drill down on a stock event or trading opportunity and share trade ideas. You'll get all my covered call and cash secured put trades that I'm making in my real brokerage account. You'll get access to our monthly online Ask Me Anything webinar, and you'll get our unusual activity alerts on options income trades and so much more. And the best part is your paid subscription helps keep this show on the air. To become a paid subscriber, just go to the Wealth Building with Options Substack page. The shortcut to that page is wealthbuildingpodcast.com. That's wealthbuildingpodcast.com. And choose a monthly or annual subscription, or for the best value, become an all-in wealth builder and get everything I mentioned, plus our Friday group coaching with John here. our smart income video class, which alone is valued at more than your Wealth Building with Options paid subscription, and so much more. Again, that's wealthbuildingpodcast.com. Until next time, invest excellently.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.